It's been a little minute since I posted on here, but today we're going to be going over how to find a fair value gap while day trading. I'm going to explain how to find a fair value gap, what a fair value gap is, and how we can use fair value gaps. Alright, let's get into it. First thing we're looking for when we're finding a fair value gap is a Drake Dick candle. Basically what a Drake Dick candle is going to be are these big long up candles or these big long down candles. This right here would be one of our Drake Dick candles because it's a big long up candle. If we notice that none of the wicks from the first and the third candle are overlapping and there is a gap between them, then that would be our fair value gap. We can see here we have 1, 2, 3 candles. This would be the first and third candle around our Drake Dick candle. And if we mark up the top wick and the bottom wick, we can see that there's a gap that is left there, and that gap is going to be our fair value gap. Now what this gap represents is an imbalance in price. That means the market moved up filling long orders and didn't fill any short orders, leaving a gap within price. These gaps can be used in many different ways, and I'm going to show you an example here in a second, but we can use these gaps to understand where the market wants to retrace to, and we can use these gaps as confluences and entries for our trades as well. Here's an example of a retracement into a fair value gap. Fair value gaps can be used for retracements just like this. This gap shows that a majority of the orders have gotten filled here. If you missed your entry here and have bad risk to reward, you can wait for price to potentially pull back into the gap to collect more orders and then take your entry. If we see that we are retracing into a fair value gap, we can scale down into a lower time frame and look for the reactions we are getting out of this gap, and we can see the first time we wicked into it, we reacted strongly away from it and had lots of buy orders getting filled, so we created all of these doji candles. And now if we keep scaling down into a lower and lower time frame, we can see how price retraces into here and almost instantaneously reacts. We can see a low time frame gap right here, and then as soon as we tap into the low time frame gap, we instantaneously react, as well as tapping into the halfway point of the 15-minute high time frame fair value gap. Here is another example. This is an inverse fair value gap right here. We have a bullish fair value gap paired with a bearish fair value gap. When we see something like this, this means that since this bullish fair value gap got closed through by another fair value gap, it tells us that the bullish fair value gap has been invalidated and indicates the trend is likely to change. We can use inverse fair value gaps by pairing them with a liquidity sweep. We can see we get that liquidity sweep off of these highs right here. When we pair it with a liquidity sweep, we can watch to see the reactions we get while we retrace back up into this inverse fair value gap. If we see that the gap is getting wicked into and we are getting strong reactions off of the gap, then that would be a good indication that the market is likely to change direction, and we could enter into our position once we see a confluence such as a break of structure. Hopefully y'all learned something from this video, and don't forget to like, subscribe, and maybe drop a comment if you did learn something, and hopefully I'll see y'all in the next one.